Good morning, everybody, and welcome to the ESG Roundtable hosted by Idea Group and FS Martech. The subject matter is striking a balance between long-term ESG opportunities and strong asset management stewardship. We have on today's panel a distinguished list of people. John Barrass, who's the former Deputy Chief Executive of the Personal Investment Management Financial Advice Association. Pauline Bush, Head of Marketing at Mirabaud Asset Management. Jill Jackson, Chief Executive of the Big Exchange. Michael Maldiner, Managing Director of Nordia Investment Funds. Simba Mambuinga, Managing Director of Devlin Mambo. And Pat Sharman, Country Managing Director of Cassis, the UK. Perhaps I could start with you, Jill. So what does good look like?
So for me, in terms of the industry, I think for ESG, first of all, I would say that we welcome regulation, right? Anything that can drive change in this area and improve quality for consumers is absolutely something that we would advocate for from the big exchanges point of view. If I think about from a consumer's point of view, what good looks like, I think transparency is a really strong part of that. So if customers are able to not just be told that something's ESG, but can see that it is, I think that that really helps in terms of what good looks like for the consumer. As always in our industry, we face headwinds of, whether it's greenwashing or somebody maybe mislabeling something. I think it's really important as we go through this regulation change and improvement as an industry that we really hold ourselves to account so that consumers can feel that engagement and trust with the industry. And for us, those are really the big things, is that we want people to trust the industry and we want people to feel that they're really connected to the investments and the impact that they're creating. And I think ESG really helps with that.
Yeah, but Pat, you do some work in the cost transparency area. How does that play out in your environment?
So I come from the custody perspective. So Cassis are a custodian bank and also pension fund. I'm a pension fund trustee as well. So I kind of come from the other side. So I think I completely agree with what Jill says. I think transparency has been a problem in financial services for a very long time and still is. In respect to cost transparency, it's taken us a number of years to try and get people to buy into it. So I think it's only really regulation that has driven transparency around costs, for example. I believe it's similar to ESG. As we know, most change comes from either the regulator or from consumer demand. So, we've seen from a cost transparency perspective, it's really been driven by the regulators rather than consumer demand. I think most pension schemes didn't actually understand their full costs, so they didn't know what they didn't know. So actually believe that they had oversight on the full cost, but they didn't. So that was really driven from the regulator, and I think it's a really good initiative, and we've been doing some work on that for a number of years, as you know, Steve. So yeah, I completely agree with you. I think one of the biggest problems we have is transparency, but probably the second one is data as well. And the third one, I'll put the third one there, might as well put it in, is education. People actually truly understanding, not knowing what they don't know, I think is a problem from the top to the bottom. But anyway, that's me.
I think everybody would agree that regulation is, governance and regulation is driving it. So John, what's your perspective on that?
Well, I find it very interesting. I mean, as a matter of fact, I have a background in government regulation. The first 25 odd years of my career was spent in government and then in the UK regulator, the FSA, FCA, and so on. So I have quite a good kind of feel for the way regulation is driving this. The thing that I observed when I was in regulation was that it tended to follow the market. It tended to, as regulators, we wanted not to get in the way of market developments. Now, there's a bit of contention there with the firms. They may not always see it that way, but in fact, that was to a large extent the way we were trying to handle things. But that has altered. And the regulator is now, and the government in particular, is leading some of this debate. And they are setting the terms in a kind of a new framework for action by firms, which firms need to pay very close attention to. The kind of detail that we're getting into is to an extent unprecedented. And I think actually it's very good for consumers because you can actually pick up precisely what firms are supposed to do. And firms have to give an account for themselves in a very transparent way, which I think is very good for the market. If you take, for example, the way in which changes to the Markets in Financial Instruments Directive are taking place, and which are now specific to Europe in the EU and not to us, although I think we should be following suit given the government's commitment in this area, that they give very specific definitions of sustainability, of what you have to do. There are sort of 4 headings to that, of what you have to do if you wish to actually offer a sustainable investment to a client, or what you have to do to get the client's interest generated, and you have to make a record of this and show that you've done it. And that is up there for people to see. So this kind of alteration, which is very much regulatory led, is very strong, and I think it reflects the determination at the political level to actually try to make some difference in the climate area. Just as an aside, we all saw, I think, David Attenborough's comment in the last couple of days to the UN, and obviously a figure like that has tremendous credibility, and he moves people's minds on things. The kind of things he is saying, in fact, they're having a huge impact. They're being taken up right down at the level where it really counts, which is the way in which you invest funds and the way in which you actually tell clients you're going to fulfill ethical and sustainability norms.
Yeah, Michael, looking at your through your lens from Luxembourg, how does that regulatory play out for you?
Well, I guess, Steve, the regulation itself is just one first piece. So we are really at the beginning of a journey. And obviously, I cannot agree more with the other speakers so far that this is really needed. So we basically also need to consider at the end that when we're taking on or onboarding to this journey now, it's also kind of a long time game. Whatever we basically draw as a first plan actually to take action on the first initiatives, we see now the SFDR, we basically see the other initiatives just being round the corner, MiFID II being a true game changer. John, I cannot agree more with you, especially to the benefit of the investors and the consumers. All this is basically to be seen in a holistic context. So where does it come from? Where's the need actually coming from? And it's also so that investors really demand these kind of products. It's not that it's just something that is driven by policymakers. It is something they really can see the demand. When you look at the figures last year, 2020, where the flows into funds, for example, here in Luxembourg, but also on a European scale, have ended up, and basically actually the ones that basically made the biggest move or progress are actually the investments into sustainable or ESG products. Now, no doubt about the fact that there can be different notions, and Morningstar I'm referring to now, they basically have their own kind of methodology to assess which product is falling into which category, but it at least shows a clear trend. And this trend will only be accelerated, not only by the regulation, but also by the client's demand, because the clients, they really want to see in a tangible manner the impact that they can have with their investment. So how can they make their investments matter? And this is what we, especially here in a place like Luxembourg, we need to basically embrace, because if we don't embrace it as a financial industry, especially here in Luxembourg, but also beyond, I guess the credibility of our entire industry is at stake. So taking it serious is extremely important to me.
Michael, can I ask a question, because it's one that we always grapple with in the pension fund world, is so let's go from a pension fund. You've got the board of trustees who are responsible, but then you've got the underlying member. And we find as an organisation and as a trustee myself, putting that link between climate change and the investments itself is really, really challenging, because there's not enough knowledge. So I agree with John's point about, David Attenborough. He's just amazing, yeah, and he brings it to the normal person on the street. And to reality, but do they really still link it to their own pension scheme and the investment? And do you not think that the investors still don't really understand? Institutional might, but the individual, and you might get the millennials, yeah, and the Gen Z might, but do the 40 and the 50-year-olds really understand where the real wealth is?
I very much agree with you there, Pat. And if we take a bit of a distinguished view at the different kind of investor segments. Very much so, the institutional investors having been the role models, so to say, in ESG investors for years and even decades. They basically have also made clear commitments to extend their ESG investments. So that is anyway already something where we can say, tick the box, right? But the retail investors, the guy on the street, that's really where we as an industry have kind of a societal responsibility in educating them. We should not basically be misled by the thinking that actually the regulator will take care of that and they will basically educate the people. That won't happen. We as the asset management industry or the financial industry in general, and there I would also include the banks, distributors, those being impacted directly by MiFID, who are actually sitting in the advisory sessions. You mentioned, John, earlier, where they basically have at the end to complete the suitability report and actually say, how have I actually concretely integrated the client sustainability preference into the way I give the advice? That's still quite a long journey. Will it basically mean that it is a difference in terms of the age segments? Certainly it is, because the youngsters, if I can say so, for the millennials and the Generation Z, they basically grow in wealth. They want to make actually also now bring their investments or their money to investments. That obviously is not having the volume of those being 40, 50, 60 plus and so on. But I still believe, and we did an own survey on that, that also among those investor classes being after or over a certain age of 40 or 50, there's also an increasing development in terms of understanding the need, because also these people at the end, they have kids, they probably have grandchildren and so on and so forth. So they also want to care about leaving something behind or hand over to the next generations that they can still say, oh, I kind of contributed to that. The question, however, is to me, because right now, and that's for good reason, this discussion is pretty much driven by the E side, environmental, climate at the forefront. I mean, that is because it's the most pressing right now. But also the social side should not be forgotten in this dialogue or in this context, because the social side will also form the future of our society at large. So taking this step by step and educating investors step by step is probably what we need to do. We should probably not aim to do everything at the same time, but be targeted. And there we all have a responsibility. I
completely agree.
So Pauline, from a marketing perspective, how do you target those people? How do you tell the story to those people?
Actually, that's a really good question from an asset management marketing point of view, and a slightly different facet to Pat's question. One consideration around what marketing needs to do is really be a reflection of the culture of the organization, which is broadly companies fall into three different buckets. One is born purposeful, so companies that have the mandate or the agenda to be responsible and sustainable. Those that are purposeful converts, and I think a lot of asset management is moving into that space, and then the pseudo purposeful, which is obviously not the bucket you really want to be considering. But when you're looking at this through the marketing lens, it's interesting where you think about how you differentiate that story as a company, because people do still buy brand. Performance is critical in this industry, but brand still sets you apart and ensures people stick with you. But when you're looking around, regulation is pushing a lot of the sustainable adoption, which means in 5 to 10 years' time, those sustainable criteria that are cutting edge at the moment are going to be standard. You would expect that of the industry. So when you're looking at how you reach those clients, it's not, in my view, always how you need to get those 40 or 50-year-olds switching investments. In fact, those investments are going to catch up. But from a marketing point of view, thinking further ahead about how you keep people engaged when sustainability is not your differentiating consideration when you're looking at the investment. And I think within marketing, the challenge, going back to the original question around what good looks like, it can be incredibly complex because there feels like a race to arms around how green you can tell your story. And that should be a given, not a differentiation or a distinction. And in an industry that's fighting, certainly coming from an active management space, where you're fighting the commoditization of the thought process and some of the the passive influence that's coming through and you're trying to make sure you're providing value to clients, then active management and being seen as responsible and sustainable should be a hygiene factor. There's a great story that comes out that how you talk about sustainability and responsibility at a brand level is sometimes your biggest story, but it should never be told. And by that, it means it should just be evident in your actions. And those actions are the summation of your HR team and how they're driving forward D&I change. It's looking at your CSR, going back to the corporate citizenship of your organization, how you're bringing it in at an investments level, how you're activating on your engagement level and tracking that, and then equally how you're talking to your clients about it as distribution. And all of that should just be evident in your actions. But what is really underpinning this is some of the change that's coming through, not only on the regulation side, but also how we're able to capture and report on the data. Because I think if you look back to the early 2000s when the ethical funds really came to a fore, some of the weaknesses there were you couldn't really evidence the actual impact you were making. I think the SDGs have provided a great framework for articulating some of that story, but actually some of the data providers in the market, especially into some of the smaller unlisted markets, the data quality is improving so much that it's improving both the front end of how we make investments, but equally how we can evidence to clients that that hygiene's being done. But I appreciate there's a lot more to do, and certainly from a marketing point of view, we've got to make sure it's telling the whole story, not simply snippets for the window dressing.
Simba, looking at across your client base, how much of this has resonance from what you see in the market?
I agree with everything, with what you guys have all said here. Big data challenges. This is being cited by various managers. It's prohibiting implementing of good sustainable practices. There's increase in greenwashing, marketing, for instance, and some of this is happening involuntary. That people don't actually see that the greenwashing, and the root cause of this are the data challenges. But I think there are ways for this to resolve this. Yeah. One of the challenges we're also seeing from the data side is the disparity. You go to MSCI, you go to other providers, you know, the correlation between the rating agencies is very limited. So how do you compare portfolios? Now, that's another challenge in itself. So thankfully, we are seeing the accountancy profession coming in with NFRD, for instance, which should standardize the information that feeds into ESG reporting at a portfolio level for the corporates, that is. But that still needs to be extended out for the smaller entities, and that's going to take time. And I don't think this is something that would achieve in the next 5 years. But I think with concerted effort, the industry can get there.
I would just add, in terms of this discussion so far, I think one of the things that the industry can do to help itself is not just talk about ESG for ESG funds, right? So there's this real drive, you know, if a fund's labelled ESG, then we talk about ESG. But in actual fact, if it's a bog standard fund that has had no ESG screen on it, consumers should still be allowed to see the impact that creates. So we shouldn't just measure that for the funds that asset managers have deemed to be ESG. And I think that helps, Pat, back to your point about, do consumers really know? And one of the reasons they don't know is it's opaque at the minute, right? Whereas if you sit down and say to somebody, right, Simba, do you know that your company pension scheme is actually invested in tobacco, oil, big pharma, XYZ, you're immediately going to be engaged with that and have some kind of opinion on that, whether it's good, bad, or indifferent. And I think that the lack of knowledge at the minute about where the money is actually got a long way to go, because I think when people do realise that, it will unlock even more potential for people to move their money into positively impactful investments. Because it's mostly been an institutional move in terms of assets at the moment and flow. We are starting to see consumers demand it more and more as awareness rises, and people's regular spending behaviours are changing, you know, as in they're going to the supermarket, they're conscious about how much plastic, their single-use plastic they're buying, whether that's because of David Attenborough's images on the telly or whatever it may be. Consumers are starting to join all the dots about the full impact that they can have on the planet. And in actual fact, all of those consumer spending actions have a great impact, and it's brilliant. But in actual fact, their pension fund is the biggest impact it can have. And that's the thing that we need to really try and make sure that advisors in the UK, and I've spoken to a few advisors, you know, where they say, you know, there's not a demand from our customers. But one of the reasons that the demand isn't there is that they've not got insight into where it is just now. And I think that that's something that if people can ask the question, where is my money just now? And then understand, is that where I want it to be? I think, and then the regulation all helps with that as well. So I think it's a combination of consumer demand, government regulation changes. It's all of these things together that are required to really create that step change. But the industry has to be transparent about more than just the funds that it wants to be transparent about. It has to be transparent about all of them, in my view.
Could I just come in there? Sorry, beg pardon.
I was just going to add, and Jill, I would also add a common language when we're talking to consumers about what we're being transparent about. I mean, at a simple level, what's the difference between sustainable and responsible? And it's just simple tweaks to the language so that we're consistent between vendors as well. Sorry, John.
Well, so I didn't mean to interrupt. I'm so sorry to come in early. No, I just wanted to pick up on the point about consumer interest, because I think this is absolutely, first of all, it's vital. There are billions of consumers. We have how many? 7 billion as a population. So there's a lot of issues here, a lot of people. But the issues for the businesses, particularly the investment businesses, which are trying to get money from consumers to invest for them, is credibility and trust. And it's a feeling by consumers that they can have confidence in the industry, that it will do the things it says it will do with the money that they wish to provide. And we had the active-passive differentiation just earlier on. And of course, if you're dealing in passive funds, then you don't quite know where they go in some ways. One of the problems you've got there is to understand what happens down the line a bit. And if a consumer asks you, then you need to be able to tell them, well, actually, we have checked. And we know that the kind of areas that the money goes into, the indices that we are tracking, do not contain companies that are in fact investing in or producing products which you would regard as not ESG compliant, or which would actually, for example, offend your ethics in other ways. There's all that sort of thing. So the issue of active quality, I think, is very important. But credibility is unbelievably important, because if you don't have credibility with consumers, they simply will not do what you feel that they should do. And the point was made earlier about the expectations of regulators. Regulators expect the firms to deliver on what the regulation requires the market to do. They don't expect themselves to go and tell consumers what they're supposed to be doing with the firms. So what they will be looking for is the results that you can offer, having gone to the consumer and developed a relationship with them on the ESG front that shows the consumer that you are committed to these kind of investments, and that you are meeting the requirements of the regulator to do so. So that sort of distribution thing is important. And just a final point, when I was working at Pimford, one of the pieces of work we did was a lot on the under 40s and their view of the market, and compared that with the older generations. It's come up here. The word trust is absolutely incredibly important. People will not invest unless they feel that they can trust what is going to happen to their money. And the lower age groups were definitely much more committed to trusting firms that were actually going to be looking at ESG work and being transparent about it than the older ones. But that didn't actually exclude people wanting to change the investments that they wanted to make in order to get more into the kind of areas they felt they should be. And that included a sort of ESG kind of approach. This whole thing is changing. It's this whole public tidal wave of interest is really shifting, and keeping up with it is difficult. And this is why I mentioned Attenborough and others, because they are the people who generate that wave.
And John, if I could just interject again, I'll reemphasize the point on culture. I think if it's culture at the organization, if implementing sustainability is easier, and it will have a lasting impact, essentially. I think the approach of implementing, say, ESG practices at desk level, or as in we have an ESG framework, or at product level, is not going to achieve a lasting effect, and it's not going to build the trust and confidence that we so desire. So we really have to look at it, that what is the culture that we want to build within the industry, and then also understand, managers to understand the investment risk that's posed by not paying attention to sustainability, as Jill mentioned earlier.
And can I go back to Jill's point about pension funds? And you know, the majority of us have a lot of our wealth within pension funds. And just to give a bit of reality to it all, so I think there are a lot of individuals out there that understand impact. But I'll go back to pension funds, and we're an educational partner to the PLSA, by the way. I can't remember who made the point about education, I think it was Pauline. And I think it's a really important part we need to play, and we've been an education partner for 3 years. But we did a survey last year in partnership with the PLSA, and we asked a question, we asked several questions, but one question which really fascinated me is, what do you think the impact of climate change to your investments is high? And then we had medium and low. Only 17% said high.
Wow.
And these are trustees that are responsible for pension schemes. And another question we asked was around, do you think you've got enough access to data to help you understand the impact of climate change? And I think it was 73% said they didn't have access to the right data. And the problem we have is we have a mistrust from the pension funds to the asset managers because of greenwashing. So they therefore don't quite believe what their asset managers do and what they're telling them. So now I'm a trustee, and I won't tell the whole story, but we've got our own story as a board of trustees, very small board of trustees for a very, very small DC-based pension scheme. And we actually sat there 3 or 4 years ago. You know, we see the new regulations come in. We need to make changes to our statement of investment principles. The implementation statements there now. We have to make it all public. And we sat there and went, well, what do we do? You know, we've asked our asset managers to be signatories to the UN, you know, the UNPRI. We've kind of got some guidance around stewardship. But what else is it exclusions we need to look at? Don't invest in tobacco, don't do this. And it was kind of, so I went and asked the consultant couldn't help me. Went and brought in an ESG specialist. I knew more than them. It was kind of, where do I go? Now, lucky for me, I work for a firm that actually helped me. So we actually do our own screening. So we've got a solution that we give to pension schemes using one sort of like rating agency, Sustainalytics, and we use them. And although it's not perfect, because no rating agency is perfect, we all accept that the data's not perfect, and it's only public, not private, so it's not perfect. At least what I can do now is I can screen across all of my portfolios, including the pooled funds. So looking through into the pooled funds, because most trustees don't know what is in the pooled funds. Trustees don't know, the members don't know. So you might sit there and be thinking, we haven't got any fossil fuels or tobacco, but is that the right decision anyway to exclude those? There's a debate around that. But at least now I've got a screening mechanism against the UN Compact principles. So what I do is I look for breaches. And now I can talk to the asset managers, and we can have what I call proper engagement to say, can you tell me your rationale for investing in that company? It breaches against the Compact principles. It's negative. It's been negative for the past 3 years. Tell me what your rationale is. Give me a copy of your engagement report. Tell me how you voted at the last AGM. But we're quite sophisticated. Asset managers actually said to us, blimey, you're the most detailed pension scheme we've met to date. We're not when you compare us to BTs and Railpen, yeah, but the normal pension scheme. So there's a massive challenge out there, and it's mostly around education. It's that linkage. And I say, we all sat there 3 or 4 years ago and went, where do we start? And no one could really help us. We had to find our own path. So there's just a challenge, but it is getting better because the data's getting better, and there are solutions out there, but it's slow.
Yeah, I think in terms of the data, I think the industry also needs to be really careful not to blame the data for not taking action, right? Because I think there's a real risk there where the industry goes, you know, the data's not what it should be, you know, how do we deal with this? Because, you know, the data wasn't quite right. And that feels in itself like that creates a lack of trust, right? If you just say, you know, I'm this professional person that you're paying this asset management fee to, but you know, the data wasn't great, so whoops, sorry. I think that at a real baseline level, right, for consumers, see, and if an asset manager can't answer the question, why did you buy that stock in that ESG portfolio fund? Let's assume that you bought it because you thought that the baseline is you thought it would make a financial return, right? But why, like, what did that do for any of those factors for you? And I think that something as basic as that is something that asset managers need to get their head around. Is if you had to give a consumer one paragraph as to why you bought that stock, what would it be?
Mm-hmm.
And it can't just be the financial return, because there's an assumption that was why you bought it in the first place, right? So I think that the asset management community needs to kind of get its head around, yeah, they absolutely need data, of course they need data, and it's complex and difficult, right? But a human, at the end of the day, the consumer is paying that company a fee, and the fee is there because they are the experts.
Mm-hmm.
They're the experts, then they should be able to answer that question. And I think that we can complicate it as much as we want, but at the highest level, a consumer expects you to be able to answer that. And why shouldn't they? They're paying you money. And as much as we've got institutional investors, or what, you know, different types of investors, at the end of the day, it's somebody's money, right? It's a person's money, whether it's in a pension fund or whatever it may be.
But it still comes back to transparency to a certain extent, Jill. There's no standards in this country for looking through into pooled funds for pension schemes.
Yeah.
There is no standard. We can't vote in pooled funds if you're a pension scheme. If you invest in a pooled fund, that's another story altogether. We'll go into that later. But, you know, so there's still a lack of transparency. So the regulation's telling us to do something on one hand, or you want to do that, but the industry isn't quite there. So you're right, we can't blame data, and we as a pension scheme didn't. We started somewhere. So, you know, my point to everyone is we're a tiny pension scheme, and we've done something. So you can all do something. It's all there, but there's a long way to go from a transparency perspective still.
I think what's great. Oh, sorry, Simba.
No, please go on.
I think what's great, Pat, just where you did start and what you were looking at is you're also looking at momentum change, and that things take time, and looking at a holding over 3 years. I think that's an important piece as well, because I think this is where the role of the asset manager really comes to play, is around the engagement that they should be doing around there. So as you touched on, is exclusion the way to go? Are stranded assets what we need, or do we need financial capital pushing for change within those organizations, which asset managers are well placed to be driving those conversations for? And I think that momentum piece is important. Unfortunately, it also creates a loophole for people to slip out the back door and stay maybe in companies where they shouldn't be because we're talking to them, but we need to create some of that data and the milestones so that we're held accountable as to why we're possibly in a holding. But I think that momentum piece is something that needs to be considered at a ratings level as well.
I would echo the point that transparency, I think, is a really difficult issue, because obviously in the pooled funds, it's not new that you don't know where the money goes and what it goes into. Equally, it's very hard. I don't think my sort of experience of regulation, I don't think any regulator at the moment is going to want to set up regulations where you have to unpick the kind of detail of the specific pooling that you do, and every sort of little piece comes out. We've got, you know, they would expect that, I think, because I mean that's going to be that's going to kill off the market. It's such a time-consuming and expensive thing to do. But the research and the downstream kind of knowledge, if you like, that is inherent in the way the asset manager can actually explain things to the client should show that they've done due diligence and understand that, as far as they can make out, everything they're investing in meets all the criteria required for ESG purposes, and they can show as much transparency as they can on that. You're always going to get, I think, a problem that there's some point at which you can't get at everything, and I think they have to answer questions, well, why are we in this, and so on. I think, again, the cultural point that Simba made earlier, the cultural change is coming on this, and it will take time. I also want to reiterate, or rather emphasize and support the point made by someone earlier, that what is now new and strange in 10 years' time will be ordinary. So you're going to get that change also in the way transparency is handled, I think.
And John, just to pick on your point that we don't need to be looking in. Sorry.
No, go on.
No, I was going to say just the point around not looking through into pooled funds. I slightly disagree, because what the regulator is saying to us is that we have to be able to assess whether our asset managers have implemented our statement of investment policies, you know, so I have to be able to assess, have they done it? So in some respects, they're asking me to have oversight of that. Yeah, that fiduciary responsibility, which I agree with. The new pensions bill is coming, you know, coming through the larger pension schemes, and probably the rest of them will have to report on their carbon footprint, and will have to do some scenario reporting in accordance with TCFD guidelines. Now that means I have to look through into those pooled funds and look through into those assets to understand what my carbon footprint is today, and what the potential of my carbon footprint should we have, they do the scenario on the 1.5 and the 2 degrees. So I have to look through. So that is where asset managers are going to start to find themselves challenged, because I will be saying there's 5 assets in this fund which are, you know, extending my carbon footprint way above to the level that I want it to be at. So I think this is going to be really tricky. I think, you know, pension funds, there is the move to consolidation, and I think that's where it needs to be, because then it makes sense, because then you've got more segregated rather than pooled. But anyway, so it's another point for debate. The Dutch standard is you have to do look through.
That's very good. I just was making the point that I don't think the regulator is going to tell you how to do that. It's more that they expect you to do it. That was my point of expectation. So, sorry.
You raise a point about carbon neutrality, Pat. I mean, that's a countrywide thing, and we as asset managers, you know, we're the ones that have got to a small extent help to reinforce that, because through the investment cycle. So how does that play out? How does carbon neutrality play out? If we don't work towards that as a single agenda, it's not going to happen.
Agree.
But what you also have on that one there is that the industry plays a significant role here as providers of capital, effectively, to all these firms here. So stewardship is important, and how we guys actually manage the affairs within the investment firm, and also manage those firms that we are actively have where we have active holdings in. So the question is, again, voting, etc., and governance. What are we doing to influence those companies to make sure that they transition to sustainability, or increase their sustainability standards? I mean, that's a big question as well. And then also understanding what is the driver for ESG here in the investment world. What is it? Is it profit? I think you could argue yes, because we're seeing a lot of traffic in that. It's Trump. But what is it? Do we actually understand that it's investment risk? So understanding the drivers for ESG are equally important. Now, you touch on transparency and data. What's the purpose for data? Data is now being used as a governance tool, really, almost solving an agency problem. Are you doing what you're supposed to be doing? So it's unfold. But actually, other managers are looking to use data as a management tool, as in how do I actually pick out my stocks to manage them in line with the expectation. That's all I wanted to add there.
If I could add one more thing in terms of especially the carbon and the climate debate in general. One thing that is sometimes overlooked is basically that, at least to my opinion, that the regulation itself, as you said, John, will not basically tell you how you got to do it, but you have to do it in a certain way that it's basically also credible, also picking up on that point. So regulation in that respect is just probably the facilitator or the fertilizer in order to make us all move. But what I often see, and looking around in the industry, is basically there's a lot of focus on those firms who basically have solutions, who are already by start or from start carbon neutral. Then there's also these exclusions on those who are basically pretty bad, right? But these are just the two extremes. There's the big bunch of investment opportunities is actually in between. That's where this theme of managing transition through also active engagement is really needed, because those firms will not disappear only because we do not invest into them. We all focus on just a tiny bit of the investment universe. So how can we actually mobilize the money, the assets, in order to basically engage with them, but also inspire them to move away, to help firms manage their transition? The risk that I see is that sometimes the view of a transition period is very, very short or very narrow. So we also as investors need to form a view on, okay, can this firm actually within 2 years, 5 years, or do they actually need 10 years in order to get where we want them to be? And can we actually afford, also in terms of having transparency and credibility in our reporting, can we also defend that towards the investors? So it's very much about where do you basically put your values, which are basically determined by your culture. So if you basically just want to be an investment manager focusing on the best in class kind of guys, well, then you probably lose out a lot of opportunities. And I often hear, you know, you want to invest into the solutions of tomorrow and you want to basically pick those who will be successful the next 10 years and all that kind of stuff. But who on earth basically says that those who are basically requiring right now capital in order to start their transformation, that they will not be these winners? So it's very much on us as asset management industry or investment managers to really deep dive, don't stop on the surface of the firm, deep dive into their operations in order to understand what makes them valuable and also where you can actually be an active owner to help them to get to where they aspire to be.
Yeah, and Michael, I think that's an opportunity for asset managers, I really do, in terms of creating that trust with consumers. Because I think if you're transparent about, we've bought this stock because we believe that we can actually get it to here in 10 years' time, the intentionality behind the purchase is this. And our behaviour during this time will, in terms of engagement, will be around this issue to help move them to this point where they're more sustainable. You know, there's an opportunity to turn this company around. I think that that's a real opportunity for the asset management industry to connect with consumers and say, you know, we've got this 2030 timeline and here's what we're doing to try and address that. So I think it comes back to, and I sound like a bit of a broken record now, but it again comes back to that transparency point. I do think that there is no shame in an asset manager saying we're funding this company that maybe on the surface of it right now doesn't look perfect, but we believe we can help it become 80% better. I think that that's a good news story, right? That's something that consumers can relate to. There's no consumer in the UK just now not consuming any single-use plastic, right? Everybody's still doing some of that. They're just trying to do less. And I think that it does create a real engagement point. And Pauline, I'm sure you know that from your marketing point of view, that if you can tell people those really powerful stories, that in itself creates trust, because you're telling them exactly what you're doing, you're being transparent, you're allowing that consumer to decide, does that resonate with me? Or, you know, do I just want to focus on the people that are whiter than white just now? I'm not interested in helping people move. And I think that that's something that's a real opportunity for the industry.
Change costs capital, you know, to move big businesses.
That's right.
To move their agenda costs capital, and the industry's got the capital they need to direct. So that begs the question, what's the goal? What's the objective that we need to have as an industry to achieve that? Because we can't do it alone. We have to do it collectively. So what's the goal that we're trying to achieve? That feels like, to me, a challenge.
Well, if I could chip in on that one, Steve, because, and also adding on to what you just said, Jill, I cannot agree more, by the way. And also the story that we can tell is actually a very credible one, because even when we look at what impact investing actually is, it actually has this element of intentionality, right? So you basically want to actively contribute to change. You want to have a positive impact, and you will have to measure it. So if you get these three things right, then basically you have all it means to show real impact in the sense of the definition. I admit, however, that when you look across the industry and all those firms, those having long-standing ESG sustainability track records, also those firms who basically just are now new to the party, if I can say so, basically they all claim fancy things, no doubt about that. And they use this kind of word, impact, inflationary. Everything is impact and everything has impact. Probably so, but if we look at the essential spirit of the word, it's really that you have this intention that you really want to do something good. And if you basically can wrap that and measure that around something, a story, then basically this is something that will also fly with the investors, because investors and consumers, they are certainly overwhelmed or probably are overwhelmed right now with all this classification. Is it an Article 6, 8, 9 product as per SFDR, and what is the definition of left and right, and have you? Institutional sophisticated investors, they understand that, yes, because they also have lawyers who basically explain that to them. But the guy on the street, he wants to get to see the impact. And if you can have a powerful communication around that, that's also how you will attract money, and that money you can then use in order to have even more impact. So it's a true opportunity. I very much agree with you, Jill, there.
I think the real opportunity as well is that long-term wealth generation, because if we're taking value out of companies today, that should really be reinvested into making them more sustainable, more greener. In 40 years' time, when people come to claim on pensions, they're going to be paying more for central heating or just the quality of life that they need. So the ESG, it's a 30, 40-year game changer, but that's where it's going to come from.
And it works, right? So I don't know if you're aware, but last year, the country was powered exclusively by renewable energy for the first time. So the subsidies that were put into that industry over the previous decade started to bear fruit. So long-term investment clearly works.
I think also, sorry.
I was saying, Steve, you raised an interesting point here, just touching to what Michael and Jill had been touching on, that this is a transition. Now, if you look at, say, I go back to the 80s or so when coal mining was just shut, and of course we understand the environmental impact of coal mining, and we had to transition away from that in a responsible manner. Of course, I think that was required. So if you look at this, the energy used from last year, Steve, where we have literally built up our capability in renewable energies over time to a point where we can almost use renewable energies with going forward. That's great. We can't take an approach where we just decide today that we are using renewable, that's it, without scaling up that capability. So there is an element of transition. So in as much as we are looking at the environmental part of it as well, we also have to consider the social implications of the decisions that are being made today. So it's a holistic approach, and quite interesting. I think Idea Group published an article last week, which was, which of G, E, S, and G do you rate the most? And I think governance is key, because when you focus on governance, it's a holistic approach. The E feeds into the G, the S feeds into G. So you're looking at everything in completeness and making decisions that are best fit to ensure that transition is optimal and appropriate.
Yes, I think that the governance thing is really important. Obviously, there's the whole issue of voting as shareholders, and how do you get that right if you're doing it on behalf of a number of private investors, for instance. That is a whole area that is being looked at all the time, and of course, shareholder rights and shareholder requirements are changing, developing, and expectations of the shareholder approach by people, for example, invest in the companies or the investment firms that may vote for them are also changing. I think the other point about this, though, is the costs. I mean, the other thing that I'm not downstream, we mentioned 30, 40-year timescales. I think that's right. But during that time, I think also you can expect a much closer look at the costs of certain kind of investment, as well as the indirect cost, as well as the direct cost to be examined by governments and regulators. I think of something like, say, palm oil, where, I mean, at which point is the cost of destroying the forest in order to make and the habitat for various species factored into the cost of actually, because palm oil is said to be very cheap. Well, is it cheap? It's not very cheap in what it does to the environment, and yet we use it all the time. So this issue of what is the true cost of, for example, a product such as that, and how does that then impact on the way in which investment takes place? That has yet to be realized in things like accounting standards or in standards which are affecting the way for example, sustainability is thought of. So I think that these are the 30 to 40-year time horizon things that are going to be developing in the future as well.
I think, Steve, going back to your point about what is the challenge for the industry as a whole. I do think that the likelihood is that regulation will be the main driver in that, right? Without a doubt. So, FTSE 100 companies having discussions with the Bank of England about how they're managing their climate risk, or, the FCA coming in with new regulation, that will always be one of the key drivers for industry making any kind of step change, without a doubt. I think what's different about this is that actually the power comes from everybody moving that way at one time. So the regulation's going that way, consumers are going that way, pension funds are going that way. So I think it's a combination of all of those things that really make the change. But without regulation and businesses getting asked these really tough questions by the people that are governing them, the change won't happen. So I think the regulation needs to constantly evolve. So the regulation on ESG, as we've all discussed now, I mean, I've done a consumer group recently with a group of people, not sadly in a room, but virtually in a room, given the situation that we're in just now. I mean, when you talk to a retail consumer about ESG, first, they don't know what you're talking about because you've said ESG, and that's one of our fabulous 3-letter acronyms that we live and breathe by. Second one is, when you explain to them what it is, they all get it. Then they all will, 9 times out of 10, ask the question, is that not just common sense? Right? Which is something that our industry needs to kind of get their head around, is that consumers don't see this as a value add. They see it as something you should already be doing, right?
Yep.
So the danger with the ESG trumpet, if you like, and blowing it too loudly, is that you create with consumers this kind of mistrust, because their question is, why haven't you been doing that all along? Because that sounds like a very sensible thing to do. So I think the regulation has to move at pace and not, implement this regulation and then, our work is done. I think it's going to have to continually push the envelope to really drive the change that we need in the time frame that we've got. Whether it's, climate and society are really converging now as issues anyway. But yeah, I do think that the regulation has to keep up with the issue and not kind of rest easy because they've implemented something that feels quite monumental. It needs to continue to be monumental and not just be static.
On that one, I actually think that regulation will keep us all busy, because that's the commitment that has been given. So they will not stop, and that is good. That is right, and no doubt about that. But I guess what is also be considered in that context is the fact that regulation is not a differentiator, even though some players in the industry play that card right now. I mean, points back at what you said earlier, Pauline. I mean, what we basically have today as a challenge is the standard actually tomorrow, right? And this discussion of it's just compliance or just a compliance exercise, not a tick the box exercise, that is actually the biggest risk that we're running in terms of regulatory as well as client acceptance. Simply because if we do not take it serious as an industry, the regulators, they will lately at the end take it serious. But in between, there's someone else who will take it even more serious. And those are the consumers. So if you don't basically use the regulation also to drive cultural change in order to deliver credible results, you can see I'm trying to catch all your arguments a bit, then you will lose. Then you will lose on business, and then you will be out of business. So regulation should not be considered as a differentiator. That's at least the point that I would like to make.
And Mike, I don't agree with you any more there. That I think, and coming back to what Joe mentioned as well, is that the more we are led by the regulator, the more we'll always have to do that. I think this might also be a game changer. We know that market participants, clients, are becoming a lot more savvy. They're becoming a bit more environmentally conscious, and they want to understand the world to live in, particularly the millennials coming up. So is this a game changer? Are we going to see some disruptive managers coming in and starting to consume significant market share because they can communicate with the clients a lot better? They have this trust. It can be a game changer. So again, perhaps there's an element around, okay, how do we utilize the information out there? How do we start consuming the data challenges and resolving that? I think the more you focus on those, and then without actually understanding what you're looking to achieve, there's a grave danger that some people might be pushed out of the market, and there will be emergent new managers that we can rely on.
Simba, I completely agree with you. You know, and it really comes back to the point on education. I think we've all touched on it somewhere. Education is so important. I'd say, you know, there are a lot of trustee boards out there that are very responsible for, you know, pension savings or lifetime savings of a lot of us, and they really do not understand this. And so therefore, I think there is a role for us all to do what I call real education, not selling our products. So we're really careful when we do our educational sessions. We do not sell our products. We really focus on, you know, A, B, C, D, E. This is why you should do it. Yeah. And we try and give live examples like me as a small pension scheme, you know, doing something. And I think that to me is probably the biggest challenge, because I think regulation will drive it, but it will just create box ticking, and it already has. I would say the majority of pension schemes, with exception to those very large ones, or those very aware ones, are just putting these statement of investment principles together with some pretty wording around ESG, put an implementation statement where we rely upon all our asset managers. There's actually no oversight or no governance. Yeah, so I think, you know, we have a job to do.
I think the disruption will actually come from technology that's not necessarily from the asset manager. So I think that the regulation leads to disruption in technology, and fintechs coming up and saying to asset managers, right, we can push this information to your customers now really easily because we've got this data here. We've developed technology that isn't the asset manager's focus, right, to develop technology for consumers. So if I take, for example, there's a new business, a fintech called Tumelo. I don't know if anybody's heard of that. And Tumelo basically democratize the access of information for people in pooled funds to see all the holdings, and they can see a bit about each of the company. It even goes so far as to allow you to vote on upcoming, you know, cast your opinion poll on upcoming votes. So I think that one of the great things about regulation is that it does require asset managers to move, but it also creates disruption from fintechs to hold managers accountable for what the regulation says. And I think it's the combination of those things that can really change the industry. So, you know, somebody democratizing that information then helps with education, then helps with somebody making a change in terms of their pension fund, maybe or maybe not. And I think that technology and fintechs have got a huge role to play in how this evolves for the consumers.
And I will do a quick sell on this. Companies like mine, custodian banks, we all hold a lot of data. Yeah, and custodian banks don't make a lot of money from data. They make money from the assets. So a lot of them are not keen to invest in data. But it's something, as a trustee, we really tried to push to build governance solutions for trustees to help them. So not right at the consumer level, but at least at that level, so the correct decisions, or more informed decisions, I should say, not correct necessarily, but more informed decisions are made. So yeah, I agree with you, Jill, that, you know, the industry should be pressurising organisations like ours and obviously the up and coming fintechs.
But I would like to add one more thing, because the disruption is not only coming from these fintechs and or regtechs that are used by the financial industry. It's also coming simply by our mobile phones, because this is basically what is also with the investor on a daily basis. So MiFID II, or the delegated acts as we expect them, they do one thing for the first time. They basically give a concrete right to every client in an advisory session to ask for the advisor's ESG or sustainability strategy and the credentials. And if advisor basically goes to the client and says, I actually recommend you this fund, and basically these are the top 10 holdings, whatever, within 3 minutes, every investor can check on the mobile, what are these companies actually doing? And then basically those at least really caring about their investments, they will ask the question back, because they have now the right. How come that basically you recommend me a fund where basically this and this kind of investment is in, if I actually have expressed that I have an ESG preference of whatever kind of sort? I guess this is also the big disruption that will come. The more people care in detail about their investment, the more people also scrutinize beyond what is actually regulatory scrutiny, but scrutinize really what is happening with their money. the advisors, the distributors, at the end, the asset managers, we will have to have explanations. And if we don't have good explanations, then we got a problem.
And I think that goes way beyond ESG. That is actually, in fact, a universal phenomenon. And I think technology is driving that very much.
I think on the portfolio analytics, as you touch on there, we can see a world where you will be screening portfolios, just as you say, on your phone, saying, I'm looking for something that scores a 7 out of 10 on E or an 8 out of 10 on the S, etc. And what's the overall portfolio score? So yes, fintech have an integral role to play here. We are already seeing certain firms in the portfolio analytics space with great products. And I think there's quite a lot of competition in that space here. With several mergers and acquisitions in play, and firms looking to scale up their ESG portfolio analytics capabilities as well.
Well, as a fintech supplier, I'm ever so pleased that you all think we've got a role to play. So, as a conclusion, ladies and gentlemen, I'm very pleased that it came back to that. And I'd also like to say that in your hands, I think the industry's heading in the right direction. So thank you very much for taking the time out, and I wish you all well.